Hi, my name is Harris. I'm one of your podcast hosts. I'm also a lawyer at Treadstone Law. For most Canadians, buying, selling, or refinancing real estate, a lawyer is the last thing on their mind. That's unfortunate because lawyers play a vital role in the process. But what choices do Canadians have? Lawyers can be very expensive. Well, Treadstone Law offers resources to Canadians so they have access to the information they need. Whether you sign up for a live workshop or a mailing list, we cover topics to help you make informed decisions and avoid costly mistakes. It's advice you can start using today, and best of all, it's free. Visit treadstonelaw.ca/MAS offer or click the link below to get access right now. If you're looking to retain Treadstone Law, it's never been easier. Our entire process is online. From completing the retainer agreement to your signing appointment, everything is done from the comfort of your own home. We're your digital lawyers. The best part of it is that you don't pay anything when you're retaining our firm. Visit treadstonelaw.ca/MAS offer or click on the link below to retain us right now. Enjoy the podcast. Welcome to another episode of Hustle and Grit. Today on our episode, we've got Sherry Corbitt. Sherry doesn't consider herself your average mortgage broker. As an entrepreneur for 20 years, Sherry has honed her skills as a realtor, business coach, marketing manager, and ultimately her true calling, mortgage broker. Her highly engaging and positive energy permeates all aspects of her life, but her knowledge and compassion for clients drive her to get them the best mortgage to suit their lifestyle. With a client-first approach, she treats her clients with the utmost care and open-mindedness as she would a close friend. To better herself and those who may be separating or divorcing, she became a divorce financial analyst, filling a gap in the industry to lend support during a traumatic time in someone's life. Welcome to the show, Sherry.
Hi, thanks for having me.
Well, that was a mouthful. So you've got your business coach, your realtor, your marketing manager, you're a busy person. And I feel like what I come across, some of the best mortgage brokers have to have an understanding of kind of everything, so that because a mortgage is not just a here you go, here's some money, and here's the interest rate. Especially now, when mortgages are no longer mortgages, it is so much more important to kind of understand the lifestyles people are living and what they're going through, and to understand what the best product is for them. So, Mike, just to kick things off, give us a run through, give the listeners a kind of a run through of a bit of your career. What made you land in mortgage brokering, even though you had all these kind of other things going?
So as a realtor was probably the longest one prior to being mortgage broker,
Mm-hmm.
and I was selling new homes. But I had my real estate license. I wasn't in the retail market, and I just really liked that component of finding the right product for the right client. So when they come into the sales office and you had to find out about closing dates and sizes and budget and things like that, it was like piecing it together. However, new home sales agents work all holidays, all weekends, and not really the easiest to have a family for. So when I was looking for a change, the mortgage broker that I knew in the industry is like, with your real estate background, you should completely look at doing mortgages. And I was like, oh, bing, that clicked, and I never looked back, because I do enjoy the finding the solution. I do. That's my favorite part, whether I'm working with a client who has a little bit of a credit issue or an income issue or self-employed or separating, any of the challenging things. I like finding that solution, that fit part, which is similar to what I was doing when I was selling new homes.
So what got you into, so you said that you were, hold on, I don't want to butcher it. You were a divorce financial analyst. Can you give our listeners just a little bit about that and what got you into that portion of the industry?
Absolutely. So as a business owner, you are always looking for a way to get in front of new clients or a unique type of client. It's called niche marketing. You want to have a
Yeah.
particular ask so you can stand out. So you're not the only mortgage broker in the room. You have something that somebody is rememberable for. And when I was looking through past clients and I was trying to figure out who did I enjoy working with and who needed my services, it became very apparent that I enjoyed working with people going through separation, very much like a first-time buyer. Everything's new, it's scary, maybe a little exciting
Mm,
depending on your situation, but there's a learning curve. And the fact is that as a mortgage broker, people would call me and they'd be like, oh, I'm thinking about separating. What can I afford? And that is way too premature of a question to ask. But I can understand why it's the first question on
yeah.
their mind, because I have to know, what your support payments look like. Are you selling your home? Are you getting equity from your
Yeah.
home? All those questions. And at the end of the day, I was hanging up on that phone call and being like, sorry, go talk to a lawyer and come back in 6 months. So it's not smart business to hang up on a call. And it didn't feel good in the soul to not be able to help that
Mm,
person. So I found this credential, certified divorce financial analyst. I don't practice in it,
mm-hmm.
but I keep my education in it so that I am well versed. I'm connected to mediators and lawyers. I understand the process. And now when I'm either networking or talking to clients, I have a unique proposition and a different way to be able to help clients.
Yeah, no, and I completely agree with you. I feel like when you say that, the aspect of the divorce side excites you, I would argue it excites me as well. But and I would say we're probably on the same page in this. Correct me if I'm wrong. It excites you in the sense that you're able to help somebody, right? Not that they're going in a difficult.
Right. Right. I'm not all like, woohoo, you're divorcing. Yeah. No, like that's not what I meant. I do like that they are feeling so doom and gloom. Their
Yeah,
world is changing. If they have kids, they don't know about where the kids are going to live and what school they're going to go to and all those components. And at least I can be that little piece of advice in the background that can guide them. So at the end of this journey, when they look back, they go, my journey was better because I connected with Sherry. And that's my
yeah,
hope.
yep. And the thing is, and this is why anybody coming to me, I would always and I have nothing against the banks again, but like I mean, I would always push them towards mortgage brokers because you build a lifelong relationship if you're working with the right mortgage broker. Because with a bank, you can't go into a bank and say, hey, listen, I'm getting a divorce, can you sit down and give me my options? That's not going to happen. All right.
Yeah.
And it's not as simple. Correct me if I'm wrong, most of the time it's not as simple as you're getting a divorce, let's chop this in half, and now you go, like, it's a plan that you have to create for a few years. Maybe that first product isn't the best product, but because of the circumstances, that's what you step in. And then maybe 3 years down the line, 2 years, 1 year, whatever it may be, you step into a better product. Is that correct?
Absolutely. So sometimes what we look at is kids in school. So a lot of times it's, oh, my daughter's only got 2 years left of high school. I really want to stay where we are, and then I'll move. So maybe we have to go into a more aggressive lender where it's not really a bank type
Mm,
mortgage, and you're going to be paying a little bit more for that mortgage, but it's because you're carrying a home that ultimately you're going to sell later. So maybe to stay in the same school district, you're stretching your finances a little bit
yeah.
with the exit strategy of, as soon as my daughter's done school, I'm going to move to a town home, a town over, and then my mortgage will be fine. So we look at the strategy there. But there's lots of little nuances with divorce that people don't even think about. So if I am separating
Mm-hmm.
and I want to buy a property, and I've sold this home for September 1st, and I go and buy a property for August 20th, you think, oh, I'll just get a bridge finance, which means that the lender will lend you the money
Mm-hmm.
off of one property to the other. You can't really do that because the property you're selling is in your name and somebody else's name. Property you're purchasing is only in your name.
Mm,
So, bridge financing, which means you're selling your matrimonial home and you're buying something prior, big issues, and nobody thinks about it. Big issues. Like, be very mindful of that.
so how I've never, you know what, that's a really good point, and it's never crossed my mind, because you hear about bridge financing every day. I'm a big proponent for bridge financing only because when people buy and sell the same day, it's a pretty big headache. um, but if you can set it up that way, it's awesome. But give the listeners a little bit about, like, what options would you have if you're not if you can't go into bridge financing the conventional way, what are certain things that they can look at to bridge that gap?
Well, hopefully, they've had a good conversation with their mortgage
Mm-hmm.
person up front and know that bridge financing is not advised.
Yeah.
Because traditional bridge financing of a few $100s to carry you for a week is not going to be your situation. Worst case, and I hate to use the word worst case, but if it does happen and you are moving because the right property came along, there are companies that do bridge financing, but that comes with a higher risk, so it comes with a higher price tag. So it will cost you, 4 to 5 times on average, I'd imagine, more than a traditional bridge, because we have to go to only one or two lenders that offer that type of unique
Yeah.
bridge financing. So ideally, you're not doing it if going through a separation. On a normal mortgage, normal move, I 100% agree with you. I want to get in that house and clean it and move my plants over
Yeah.
and do my stuff. I love bridge financing. On a separation, be super mindful, and that's something that you wouldn't know if you just walked into the bank, right? They wouldn't give you that much thing.
Branch, or if you walked or you spoke to a professional that did not know the nuances, just because. I mean, and what I say is the like mortgages are no longer a mortgage anymore. There's so much more to it now, that for example, with the banks, they've got a certain type of risk profile. Mortgage brokers have a book of business or a book of lenders, sorry, that you can't step through and say, okay, well, you know what, this is what your trajectory is financially, and you can give them the right products each step of the way. Because with the bank, and again, I love banks, I'm not saying there's anything wrong with the banks, but the banks are highly regulated. They can only sell their own products, and so if your shoe size is a shoe size 10 and they've got a 9 and an 11, they're going to give you the 11 just because they don't have a 10 and an 11 will fit, right? But if you want to get the 10, I always say go to the broker, because it's not something that's small. But in terms of, and even the other stuff that you just kind of stated, it's something that I'd assume it's common sense, but I guess being a real estate lawyer, I just see the last mile where everything's kind of put together. I don't see a lot of this stuff in the beginning, which is if you want to stay in a place for 2 years, and like you just said, because your children want to finish high school or whatever it is, there's other products. Now, I'm assuming, correct me if I'm wrong, you're speaking about a private mortgage.
Well, there's really three types of mortgages
Yeah.
that we like to say. We like to say bank type mortgages.
Yeah.
I don't want to limit it just to the banks, though.
Yeah.
I do love the banks. We work with TD and Scotia, but bank type mortgages. Then you have alternative type mortgages. They're
Mm-hmm.
not quite private, so they might be about 1% higher, and they might have a 1 or 2% setup fee. So very moderate, but they don't have the same regulations. They still have guidelines, but they might be able to look at things a little
Yeah.
differently. I'll give you a great scenario in a minute. And then the third type is the private lenders, who are all about exit strategy. Why are you coming into this product? How long will you be here? And how are you going to get out of it? And that would be, so yeah, we have different types of categories. What I was going to mention about the alternative lenders is that, for example, so bank lenders, they're regulated. They can do a 30-year amortization max.
Mm-hmm.
Alternative lenders, still very similar rates. Right now, the rates are like,
Yeah.
um, they can do a 40-year amortization. So though you don't want to maybe have a mortgage for 40 years, it lowers your payment enough that you can stay in that particular product for that time.
Yeah. Okay.
Yeah.
Yeah. So, I mean, you know what's interesting? Actually, the other day on the podcast, we had a private lender, and because I wanted to dispel some of the myths people have about private lending, because sometimes people are like, "Oh my God, it's very expensive," and one of the things that we had covered briefly, because it was just a lender and we didn't have anybody with your expertise, was the divorce side. How sometimes you just need a private mortgage to get out of the house. Sometimes you just don't want to live in the same house. So there's so many different solutions to that. Um, my question then, because it seems like you have a rich knowledge in the divorce side and the mortgage side. Um, what's the best time to reach out to you?
Well, I was, before I became the specialist, I was finding I was almost the first call. So
Yeah.
even before they had knew to go to a mediator or a lawyer, or even understood what a mediator or a lawyer was, I was getting that call super early. So honestly, the earlier the better, because I probably can't help you at that stage, but at least I can give you some advice. I actually have a book that's on Amazon that we wrote. That's a collaboration. It's a collaboration of women who've been through separation, and it's their little tidbits called "I Wish I'd Known."
Mm-hmm.
So it's things they wish they'd known beforehand. So I give that out to anybody coming. There might be something in there that really intrigues you or really saves you a lot of money later down the road. It could be that thing about bridge financing, but it's not just about mortgages. There's ones about life insurance policy. Should your partner, if they're going to your ex, if they're going to have support payments owed, should you not have a life insurance policy? So heaven forbid they pass away, your children who are getting that child support is
Mm-hmm.
still coming. Have
Yeah.
you even thought about that?
Yeah.
And then
Yeah.
who should be the beneficiary of that policy? Should the ex, be allowed to change that policy because he's mad one day and decides I'm not going, I'm changing it, or should you only have control to change that policy? To answer your question, the sooner the better, because even if it's only a 10-minute phone call, I just want to give you advice. And even if we're
Yeah.
not going to mortgage together, it's not about that. It's about making sure that you have some guidance on where to go, some support groups or mediators. The difference between mediator and a lawyer, what is
Yeah.
for divorce reasons? What does that
Yeah.
mean? So,
I mean, for me, and I've done a few mediations for divorce, and I always prefer personally. Okay, this is more. I'm not giving anybody legal advice here, but I personally prefer somebody going to a mortgage broker, or just sitting down, and a mortgage broker gives people the hard truth because you could see, hey, this is your asset. Majority of people, the biggest asset they got is their house, and it gives them a good understanding of where their finances are, even though they can't do anything about it, because often enough when you look at that, you are better equipped, I would say, emotionally and mentally, to kind of let go whatever may be holding on against the other person, and saying, all right, you know what, financially this just does not make sense for us to drag it on. Let's kind of, we had a good run, and now we want to separate, and let's respectfully or peacefully or financially soundly separate, and be on our way. And I feel like that has to happen when you look at your finances, because I've had conversations with people where they're like, I'm like, what are you fighting about? Like, this is costing you more than the actual thing that it's worth. So you just gotta,
yeah,
um, so
you got to draw that line, right?
yeah.
You've got to take that next step and rise above in a way, but you've got to be there. And if you're not there, you need to seek the support through therapy that'll get you there.
Yeah. So my question, and then back to that just customer journey. Give us that client journey that you have. So they come to you in the beginning, first call, right? And you're giving them a book, and I'm going to leave the link to the book in the description to the podcast below, if you guys want to check it out. But so you give them that book, and then what happens? So then they should go to a lawyer, go through the mediation and all of that, hopefully end up with a separation agreement, correct? Or are you kind of pulled in the middle of it as well?
I ask to be pulled in. I
Yeah.
suggest that if we're going to work together, that before you finalize your separation agreement, we look at the details. One thing that people get tripped up on a lot, and this is why working with mortgage broker has more lenders that we can
Mm-hmm.
pull from. There is a large portion of the bank type lenders who will not take support payments as income if you don't have 3-month history on it. And so many times the separation agreement says that the support payments don't start till after you've moved out of the home and the
Mm-hmm.
home sold. So say we have somebody come to us and we're counting on $3,000 a month in spousal and child support. That really limits our lenders on who we can go to. If that support's not going to, and you're selling your home for September 1st and you're moving in September 1st, but the support doesn't start till October 1st, 1 month later, there's no history on that support. So I don't want to name any particular banks, but I can't think of a bank lend who would let me do that
Okay.
mortgage, because we need that support payment history. Otherwise, they're like,
Yeah.
So if I can tell you that while you're writing the separation
Mm-hmm.
agreement, you may find a way to write in that, okay, we need 1 month prior to the closing of the home, just so that whoever's using the support can then qualify for the mortgage when the time comes. So I do ask, or suggest that when they're getting to the final draft, if they have any mortgage questions, feel free to pull me in, to have their mediator call me, their lawyer call me. I'd be happy to share anything that I'm allowed to disclose. And we're a team, right? We all want to get you across the finish line and on to the next chapter.
So, and then after the separation agreement's finalized, how does that last kind of leg look like? Do you represent only one party, or can you represent both sides? Like when you're doing the refinance, how does that work? What kind of information do they need to give you? So, what is it like until the finish line?
Well, I can definitely, and I have absolutely worked with lots of separating couples, both sides of it. I mean, they find it easier because they all have to supply the same paperwork, the sold agreement, the separation agreement, things like that. We keep all conversations confidential,
Mm-hmm.
obviously. So what one person does, the other doesn't know. They don't, but um, sometimes it's easier to work with both parties because the down payment's coming from the same source, the separation agreement's the same. Um, Regardless, so they've done their separation agreement. Now we're ready to sell their home and purchase something else. We talk about the bridge financing. I give lots of advice on try to match up your closing dates, or even couch surf for a week where you don't need a
Yeah.
property. And then they're treated like any other client during my journey, right? The only difference really for a divorcing client versus a regular client that might be a first-time buyer or refinance, or any of my other clients, is really that upfront portion of being able to give them advice. Other than that, it's pretty much we handhold all the way to the finish. Make sure you get
Awesome.
there.
And then interest rates. Moving on to the grand old subject of interest rates. Um, I know. So when I was again the other day when we did have the private lender on, interest rates for private lending hasn't really changed a lot. So for a lack of better way of saying it, it hasn't been a better time to get a divorce, because if you need a private mortgage, the interest rate there's a huge difference between the interest rate on a private versus just like a fixed, if you were to get in for 5 years. Because I think rates on average for private variable, you could get something that's prime plus 4%, which is probably around 6-7%. And you've got fixed at, correct me if I'm wrong, 5. We're above 5 now. So it's not
Yep.
a huge difference. Do you see that changing? What's your opinion on the market? I know that we had inflation news come in, 7.7%. I know this is a crystal ball question, so I'm asking you. I'll tell you why I'm asking you, okay? Because I think this is my dad's told me growing up that when you talk to somebody who isn't an expert, even when they're right, they're wrong. And if you talk to somebody who's an expert, even when they're wrong, they're right. Because even though their projection may be wrong, the mechanics and the stuff that they're leaning on, the bigger picture, the principles that they're looking at, because they have that expertise in that industry, it is right. Whereas somebody who doesn't have that, even if they're right, it could have been a guess. So that's kind of my impetus behind asking. Where do you see, like with inflation going crazy, you do see, I would say, arguably, businesses and people arguing about going into a recession. Where do you see like the interest rates by the end of this year? Do you see another 200 basis points? Where do you see it going?
All right. So this is where I go, and it's my crystal ball prediction. I am an
Yep.
optimist by heart, so I'll start with that. Here's the truth. In 2019, the prime rate
Mm-hmm.
was 3.95. Right now, it's 3.7. So that's the Bank of Canada prime rate that we base mortgages off of. So 3.7 is today. 3.95 was in 2019, before the
Yeah.
world
Yeah.
exploded, right? So really, them adjusting by 0.75, which is the estimate that's coming in July, is not going to be the end of the world. It's going to put you in the
Yeah.
low fours. And it's 2019, we're at
Yeah.
3.95 anyways. We're really just getting back in one way to where we should have maybe been if we didn't have to have COVID on the table and all the other things that happened to bring the economy down. So I think, all the doom and gloom out there is just that. Like, I think it's hyped up because my education's actually in journalism, and the fact is the rule number one,
Yeah.
day number one, if it's bad news, leads, right? So I don't foresee prime rate. I do believe
Yeah.
it'll go up in July, for a couple reasons. I think
Yeah.
it's warrant to go up. I believe it's been called for, so it's going to go up to save face. And then I think
Yeah.
it's going to stop. I truly believe we will see the 0.75 in July, and I don't think we'll see another increase for the
Yeah.
remainder of 2022. And having said that, if that brings it up to, if my math is correct, about 435, 445, that's not the
Yeah.
end of the world. Variable is still a great product, because how in mortgages variable works is whatever the Bank of Canada prime rate is, your mortgage or your line of credit is a
Yeah.
variance to that. So line of credits are usually, half a point or 1% higher, and mortgages are usually about 0.4, 0.5 under. So you're still going to have a variable mortgage in the
Mm.
3% range, and you're going to have a line of credit in the high 4% range. That's not horrible, really. I think what's happened is that we are just gotten so
Yeah.
spoiled that, at one time you could get a mortgage at, in the low 1% range. And yeah, for the people who have those,
Yeah.
hang tight because you're going to want to keep those. My
Yeah.
trend prediction is going to be that we are going to see a lot more people leaving their current mortgage as is, as opposed to the tradition. So 60 to 65% of people usually
Mm.
break their mortgage, a 5-year term, by year 3 to refinance. I don't think we're going to see that. I think you're going to see somebody who's sitting at a 2% mortgage be like, oh, I really don't want to give that up for a 5% mortgage. We'll see second mortgages come into play. Lots of second mortgages or second mortgage products. When I say second mortgages, yes, I'm talking
Mm-hmm.
about the traditional, my first mortgage is with Scotia, my second mortgage is with another lender. You're also going to see lines of credit come in huge into play. I believe that. I think people are going to look at their first mortgage and be like, it's perfect. I'm leaving it. I'm happy with it. I just need that extra money. So lines of credit, secured credit cards, which are, again, right now they're
Yeah.
under 8%, and and second mortgages. That's going to be the new thing. We're not going to be breaking mortgages. We're going to be riding them out till the end
Yeah.
of their
And
5-year term.
and I completely agree with you in the sense that the doom and gloom is overhyped. I feel like when COVID started, actually, to caveat, to step back a little bit, I feel like the Bank of Canada is there to stimulate the economy. That's the purpose of its existence, right? When things are supposed to slow down, or they think they're going to slow down, they inject more currency, more liquidity into the market, so the economy keeps going. When it's getting overheated, then it tries to slow it down. So when COVID first hit, there wasn't that much doom and gloom in the media in terms of interest rates. Everybody's like, "Oh my God, it's going down!" And at that point, the whole world was locking down, and we've been in one of the longest lockdowns there was. And so the interest rates went down, the economy kept going. Now, when the economy is actually opening up and people should be optimistic, you do see that inflation's getting a little crazy, which is why they need to slow it down, and they want everyone to take them seriously that they are going to slow it down, which is why I feel like they're really kind of in your face by saying, hey, it's going up. That doesn't mean it's, like you said, a bad thing. I mean, prior to the pandemic, 3% or wherever we were at, there were historically low rates. I mean, there were still very low rates, and we do need to, just from an economics perspective, it's not healthy to keep giving away free money, essentially, because we're looking at 0.99. So I don't know how low it can get. And especially now, what I see is if inflation's 7% and your interest rate's 4%, your real rate is actually negative. And that's what people don't realize. Whereas before, if inflation's 1% and your interest rate's at like 3%, you're still at a positive. So the value of money is changing a little bit too. So, and that's a whole different podcast. So in terms, but going back to kind of where we were in terms of divorcing clients, does that change anything for them, or is it kind of, you know what, you're whatever's happening in that broader market is not is the effects are going to be similar to divorcing clients, or is it going to be a bit more exponentialized, more sensitive in that area? What do you see with that?
Well, the divorcing client, like any client, still has to qualify at the same rules. So what I foresee, because you had mentioned earlier how you were seeing the private rates not being that much different,
Mm.
I'd mentioned that middle category, that alternative lenders who offer
Mm-hmm.
amortizations or higher income versus debt carrying. Those lenders right now, as of this morning's, when I'm looking at rate sheets and I'm comparing a bank one to the alternative one, we're talking like a quarter point. So
Yeah.
for people separating, if we need to stretch out that to make you a single income now is actually a good time. There's lots of options there because
Yeah.
that middle lender is trying to get a bigger piece of the pie and they are succeeding. This is for them, they're probably all sitting back going, oh, how do we do this?
Yeah.
um, so yeah, if your bank says no, doesn't mean it's a no at all.
Okay. So just to wrap things up, if the listeners want to get in touch with you, what's the best way? Should they email you? Should they give you a call? What's
Yeah. So yeah, email Sherry at sherrycorbitt.ca. My website is mortgagesindurham.com, though I work anywhere in Ontario
hmm
or across Canada, but Ontario is where I hang my hat. Call, text, whatever. I'm easy to get a hold
And I'm
of.
gonna have all of Sherry's contact information below or on the side wherever you're watching this from. Contact her if you have any questions. Thank you for coming on the show, Sherry.
Yeah, absolutely. Thank you for having me. It's been fantastic.
Awesome.